So I'm Tino, founder of Upgrade. We do education and tech. So I listened to you talking about adjusting your model or basically the business plan until you kind of get that exponential growth. And then you talked about basically when do you know how to persist and when do you know how to do that. From your experience doing that, do you have any insights? I think we're facing something like that right now. Basically, we grew like 130%, but it feels like last year. But it feels like we're like really pushing, like everyone on the team is like really pushing for everything, like all the departments, sales, marketing, and so on. So it's like a question of like, how do you know if that's like the right way, or should we like kind of pivot so that we see like an easier way towards that exponential thing?
Yeah. So first of all, I would take everything that I say with a giant fistful of salt. In English, we say take a grain of salt, but I think a fistful is better because it's incredibly difficult, and there's no right answers. Even if I spent hours and hours and hours digging in with you into all the details, I probably still wouldn't have the right answer. So that said, I like to think about these things as a series of thought experiments. And so you can think about the thought experiment as, let's break it into 3 buckets. So let's first start with the product, and then let's then think about the marketing, and then let's then think about the outcome. So, and the best way to think about it, so like, let's start with the product. So in a perfect world, you have a perfect product. Nothing is wrong with it. It fulfills the vision that you have of what you want. In reality, you're not there, right? Like you're missing certain things don't work, there's bugs, there's all this shit that is normal in building a product. The question you have to ask yourself is, how far are you away from each incremental improvement in the product that will have a incremental improvement in the impact that it has when you talk to a user? So for instance, let's use Uber as an example. The idea, push a button, get a car. That's the ideal. In the beginning, you push a button and you wait 20 minutes for a black car to show up. It was still better than a taxi. So that was enough to basically get to the point where people were excited to get that product, but it still was not the ideal of push button, have a car. Your product, I'm assuming, is at a similar place. There's certain things that you want to do. You have to basically, when you chart it out on a graph, you put all the different things that as a function of work, how much work you need to do to make those improvements. And if those things are achievable, then you can accept them. If there are things that are dreams, you have to be largely sort of like, okay, this might take a while. Maybe product is not going to solve our problems. The second area is marketing of the concept. And so you can think about marketing of the concept as usually as a function of channels, which is like, go back to Uber. Push a button, have a car. Great. You to me, I just sold you on the idea, you're like, yes, I want that, done, easy. But how do we get that to everyone else so that they not only hear the message, but then they respond to the message, and then they go to the website, and then they download the app, and then they put in their credit cards, and they do all the things. And so you have your existing marketing channels, whatever those marketing channels are in the status quo, and you're improving them as fast as you can. But generally what I like to do is I like to look at how big is the channel versus how big I am today, and how much leeway do I have. So like when Facebook first started and you could buy a click for 2 cents, well, there's a lot of leeway and the channel's really big, so like we can market the hell out of shit on that channel. Versus, now it's incredibly expensive and it's very complicated and it's a non-trivial endeavor. You have to look at that map and say, where are we on that curve? Is it a lot of easy opportunity, or are we running out of space? And that running out of space is, that's when you should start thinking about like, maybe we should change what we're doing. And one good way to do this is Google search queries. So like if you're marketing a product that fits in the Google search queries, there you can very easily look at where you sit relative to the number of queries that happen on any given day, month, week, and where you sit relative to your competitors in terms of the value proposition that you bring on that search query versus what they bring, and then what that means in terms of effective CTR and CPC. By the way, I can talk way too fast, so if I get talking too fast, you guys can just tell me to slow down. And then the third thing is just how well does it work? Because at the end of the day, when you have a product that's working, what you find is that the customers will tell other customers who will tell other customers, and like it will start to develop momentum And if you have a product that is not working very well, what you'll find is you're pushing really, really hard to get customers into it, but then nothing happens after that. And so like the question then, it kind of circles back. Can you fix that, or is it unfixable? And if it's working, great. I'd say keep pushing. But if it's not working and it's not fixable, I'd say potentially iterate. It was a very, very, very short way to think about that problem, but like, and it's much more art than science, but that's kind of how I like to think about it. Who's next? It's got to be something hard. Yeah, go for it.
Hi, Zach. My name is Alan Alvarez. I'm actually coming here from all the way from Costa Rica.
Wow.
Yeah. I'm actually in a fundraising right now in the US, in Austin, Texas, with a firm that is called New Chip. We've been getting traction in our country, and we're trying to find a way to get into the US, and actually we're opening right now. However, the funny thing of the story is that we've been attracting a lot of investors, VCs, from Latin America, but not from US. So what is that thing that you, as an investor, would say is the key to call the attraction or the attention from the VCs firms in the US, that it's going to help me to grow fast in this complicated market, because it's a complicated market, right?
Are you just focused on your market, or which markets do you focus on?
The idea is to expand to US, specifically Texas or Florida. We're actually in the investigation right now.
And what do you guys do?
We're a tech platform that is currently helping big corporations to innovate in benefit and tangible benefits in childcare, senior care, and pet care. Now that corporations, after the pandemic, it's having people in the house, right? So now that they are turning into a mixed, hybrid model, it's going to help them whether to go back to the office or to stay and receive some help.
I'll give you 3 answers. None are for sure right. One, there's a lot of companies that in that space in the US, not necessarily doing the exact same thing that you are, but focus on employee benefits. I'm not an expert in that world, and I don't spend any time there, so I don't know that much about it. But I do know that I see a lot of pitches that people send me around that space. And so it's complicated and difficult when you're coming from outside of the US to break into a crowded market like that, unless you've developed really significant traction that US investors can get excited about, because you have, unfortunately, sort of the detriment or the handicap of because you're coming from outside the US market, they don't know you. They don't have a personal relationship with you. They don't have the same level of trust that they would have with somebody who went to Stanford and worked at Facebook and is friends with their sister. And so you see that a lot. Like you think it's a joke, but it's actually what happens. It's amazing how well those sisters get funded and their brothers. I mean, it's crazy. But that's just the nature of the beast. And so oftentimes for the companies that I work with that are overseas, before they start to raise US capital, they're either doing something that's incredibly new and different, at which point I will quickly walk them in front of a bunch of VCs and we'll see if there's actually really any traction there, or the focus is instead on getting real measurable deltas over the competitors, where you can say, okay, their CAC is X, our CAC is Y, their LTV is X, our LTV is Y, our ACV is X, and you can kind of go down the metric by metric level before you start to break in. That's one way to think about it. Another way to think about it is why do you want US VCs? At the end of the day, I don't think US VCs are more helpful than any other VCs. I think they look good, but I don't think it really matters. So a number of companies that I've worked with have tried to spend a lot of time raising US capital because they think it's important, and then after they raise it, they're like, it doesn't actually do any good. So I would argue that to any entrepreneur that I work with, always, if someone's offering you money, take it. Don't worry about trying to get better money. Just go take whatever money you can get and then go prove your business and grow it as you go. I forgot what third thing was. I think that's enough. Yeah. Cool. Anybody else?
That's actually interesting. Do you say take any money? Because I've always been told it's you need to go for smart money. And especially when it comes to, for instance, corporate venturing groups, that is then considered stupid money, and smart money is the ones who have a network and help you, etc. So are you now contradicting that, or is that
Yeah, so in a perfect world, we only date people who are beautiful and intelligent and love us and blah, 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 blah. In reality, we date whoever will date us. Like at the end of the day, it's sort of similar. It's sort of similar, like, it's very similar with VCs. If Benchmark wants to give you money, great. But like at the end of the day, you get what you get. Like you're in whatever position you are as an entrepreneur and spending a lot of time trying to get something perfect versus just going and building your business. I usually say, go build your business. Now that said, there is the dumb money that has the ability to fuck up your business can be a death sentence, and oftentimes is really, really, really problematic. And so if your choice is between two different sources of capital and both of them are dumb, definitely choose the one that doesn't want to basically go mess around with your business and tell you what to do and doesn't have a lot of control. Because I've seen over and over and over again, bad investors can fuck up businesses. And so I would be terrified if I had to do that. But if I was an entrepreneur and I was building a business and that was my only choice, that's what I would do. But yeah, obviously smart money is better than dumb money, but you know. Beggars can't be choosers, yeah. Anyone else? Okay, yeah, go for it. We can ask as many as you want. I don't care. As long as they want to let you keep asking questions, go for it.
I just had a follow-up on that, because what we're thinking about is also like pricing when it comes to product. You mentioned if product works or not, and how people, then tell other people about it. And I was wondering what role you have seen as pricing play in this equation. By that I mean, because one school of thought is like, you can lower the price that will increase the relative value of the product, and people will see it better. But there's another school of thought that says, look, if it's a shit product, like no price will like sell, and you're basically just decreasing, the margins that you have. So, which ones did you see more happen in practice? Did you see more like pricing as, like a factor in like people, getting value for it, spreading the word, or more like not really?
So as a general rule, if it's a startup that's worth doing, which means you have a significant delta over your competitors, you should always charge more. At the end of the day, most entrepreneurs are so... what's interesting is that like when you're first getting started and your product is shit, and you generally are like, you're so terrified of having price be the reason why people don't try the product, you generally price it too low. And then at the point that you actually cross over from basically having a shit product to having a product that people actually like, usually they still keep pricing it too low. And so like there's an old saying that Benchmark says, which is I think true, just raise your prices, always. And most entrepreneurs I've seen consistently have a bias against doing that, but when they do it, they consistently succeed. So I'll give you a good example. One of the companies that I advised and invested in, they were giving their product away for free. And they were making money by selling the data that they were able to gather as a result of giving their product away for free. And the data market imploded, totally went to shit. And they had to make money quickly. And so they were like, oh my God, we're fucked. And like all of us around the table were like, guys, you've had these customers. They've been with you for years. If you start charging them, they're going to pay you. And they're like, no, they're not going to. I'm like, come on, you're fucked otherwise, just do it. So they start charging their customers. It's a $30 million revenue business now. It was a $1 million revenue business then. And they still are only charging some of their customers, and I'm constantly fighting with them to charge more. But like at the end of the day, if they had been charging from the beginning, they would be in a better place. And generally, if your product is good enough that they like it, you should charge more. That's the failure mode that I consistently see. The only time that's ever the case that's not the right answer is if your competitors charge so much for their products, and you can basically provide your product at a very cheap rate, and you have a marketing channel that can reach so many people that it pencils out that you can say, okay, they charge $10, we charge $1, but we can reach 20 times more customers than they can, and eventually we can swamp them at the bottom end of the market. So sometimes it's a good strategy. The best book on this is there's a book called Monetizing Innovation, which he basically writes. He's one of the guy who writes it is one of the pricing experts of the world, and he writes about how to think through all this stuff, and it's the best book I've seen about it. But I'm also not a pricing expert, so like I'd read that book and listen to them. Yeah.
I have a question that it's either going to have a very boring answer, but given your potential in passion, maybe it's an exciting answer. There's a lot of companies in this world, or organization in this world, that say they are an accelerator, and they want to sort of accelerate your development, and they sort of promise that you're going to be a so much better startup if you're with them than if you're trying it on your own and whatever. What's your sort of take on accelerators?
I mean, I think it's like, what's the right answer here? Most accelerators are crap. Some of them are amazing. If you're lucky, like so for instance, YC. So when YC first started, I mean, Paul Graham is literally one of the geniuses of the world. And if you were lucky enough to work directly with Paul Graham, I mean, he really did accelerate your business. I mean, there's a reason why he's so good. Since Paul Graham stepped away, it's become more hit and miss. Some of the partners at YC are amazing. Some of them are total garbage. And it just depends on who you get connected with and if they actually grok your business and they actually have the bandwidth and the cycles to spend time in your business and they can truly help you grow that business. But that said, like, it really comes down to the individual. It's like any teacher in the world. Most teachers in the world are garbage, but some of them will truly change your life. The question is, how do you differentiate them? And I have no idea. It's very hard.
Not so much, let's say, the accelerator process in itself. It's not any accelerator will already do, but it's basically find your right mentor.
Yeah, because at the end of the day, like if there was a formula to this, then people would be able to successfully do it. And even YC doesn't, like if you look at YC, the thing that they've successfully been able to do is they've been able to recruit amazing, really high quality people to join YC, and then they've been able to get all the investors to invest in all those businesses. But the actual acceleration part, other than the network of founders that are part of YC, I think is like hit or miss, depending, unless you have a partner that's amazing, then it can be powerful.
Okay, this has given you guys a little bit more time. Any question?
Go for it. Harder the better.
When you were giving a talk, you mentioned that you prefer companies that sort of throw out the rule book, or at least know which parts of the rule book.
A little bit closer, please.
Yeah, a little closer so we can hear you.
Sorry, can you hear me now? But in your talk, you were mentioning how you prefer companies and founders who look at the rule book and then figure out which parts don't work and throw those away. Do you feel like that is there's a bit of a geographical divide in that attitude of investors? Because I get the feeling that European investors tend to be a lot more metric driven. Is that a very particular Silicon Valley thing that you've got going there?
Yeah, so I'll give you a couple answers to this. In most venture capital partnerships, you have a bunch of partners at the table. At the end of the day, the reason why you have a partnership is everyone wants to make sure the other idiot doesn't lose their money. And in some ways that's good because you got a bunch of brains thinking about a problem. In other ways that's bad because there's groupthink and metrics become an easy way to convince other people to invest in a company. You're like, look how fast it's growing. And everyone's like, look how fast it's growing, and everyone invests in it. Versus if you walk the partnership like, oh my God, they're amazing. And they're like, well, what metrics do you have to prove that? And you're like, none, the founder's amazing and he breaks all the rules. I love him. It's hard to get a deal like that through a partnership. And so yeah, on average, metrics are the way that most VC partnerships and most VC firms are partnerships. That's the way most deals get done. That said, if you look at the winning companies over the last 50 years, it's literally one rule breaker after another. Like, I mean, if you look at, at Larry Ellison at Oracle, he just fucking went in and just shattered all the rules. He still does. He's like, fuck rules. If you look at Larry and Sergey, like they literally were breaking rules left and right. If you look at Uber, every single company, Airbnb is a perfect example of just like, of seeing the things that you need to be great at and then also seeing the things that like you needed to break. In this case, it was the idea that the home is this magical sacrosanct place and no one will ever enter the home except for you. And they were like, that's a dumb thing. Fuck that. Like, let's take advantage of this idea. And, Travis was like, Taxi lobbies, I mean, literally, Travis and I got in this huge fight. We yelled at each other for like 2 hours when he first started Uber about whether or not it would work. And I was like, dude, the taxi lobby's gonna fuck you. Me and everyone else said the same thing. And he's like, fuck them, I'm gonna win, I'm a fighter. And he was like, look, if I can fight through this really entrenched lobby, on the other side of it is a giant green field, because if you push a button, you get a car, it's amazing. And he was right, and I was wrong. I wasn't investing then, so I don't know if I would have invested in him. But now it was a lesson that I learned that like, it's the rule breakers that consistently are the big winners in this business. So I don't know. That's what I look for. It seems to work.
Isn't the fact that if there would be great metrics, every VC would be rich, right? Because,
Exactly.
So apparently it doesn't work.
Yeah, I mean, if there's great metrics, then it's really easy to, like, what you see is that once there's great metrics, then every VC shows up and drops a term sheet. And then instead of getting it at 10 pre, it's 200 pre. And then, there goes 20x in multiple. So, yeah, no, it's part of why I seem to do well is my willingness to say, fuck it, let's go. Yeah. Any more? Or we can be done. It's up to you guys. Yeah, go for it.
Thank you. Thank you for your honesty. I appreciate that. You mentioned that in order to invest in a European company, you need either to be super new or to have a lot of traction. Can you please define what traction is for you to be in that space?
Yeah, I mean, so traction is it depends on the segment, obviously. So, if you're doing a consumer product, it's your ability to acquire those consumers, the cost of acquisition, the growth rate, or however you're acquiring those consumers through those channels that you're acquiring them. Where I invest in B2B software, for me, it's relatively straightforward. It's like, how much does it cost to acquire a customer? How many customers you have? How fast is that number growing? How much does each customer pay you? How long do they stick around with you? How excited are they about the product, which can be measured both in terms of their sort of like upsell rate. So you sign them up for a $10 seat, and the next month they get 2 more seats, and the next month they get 3 more seats, which is what we call retention rates. There's a bunch of expansion rates, actually, obviously. There's a bunch of metrics that you find in B2B marketing. But at the end of the day, it really comes down to like, are customers excited about your product, and are there lots of them? And can I call up somebody who's not one of your customers and say, hey, this is what's there, and then they're like, oh my God, I want that. I want to push a button and get a car. I want that. It's such a simple idea, but in actuality, it's like, it's really all there is to it, is you make something that people want.
So it's more about behavior, and it's less about a minimum MRR.
Yeah, in the beginning where I invest, it's about behavior, and then once you start to see sort of like revenue, and it's like starting to become large, certainly over $500,000 to $1 million in ARR, then you can start to break it down in terms of like, where you sit relative to other companies on your particular metrics. And that's where most VC firms will be happy to write you a term sheet if you fit in the right spots.
Thank you.
Any more? Are we done?
I think that's a wrap, right?
Cool. Thanks, everybody. Have a great day.